So what exactly are mortgage points and how does this all work with lenders? How does the lender get paid? What happens with your loan once you're done with it and you're in your house? I think a lot of you will notice that you get sold to a secondary mortgage market or your lender, it just changes over. Mine changed over from Bank of America to Mr. Cooper to a bunch of different areas. So I'm going to explain that to you real quick, okay? So when you go and get a mortgage, you can buy down the interest rate. All right, you'll have that option when you're going to get a loan. And what that basically is you are able to pay. It's usually about 1% of whatever the purchase price is to buy down the interest rate. Okay, so it equals 1 point. All right. Now, it doesn't mean that it's going to go from a 7% interest rate down to a 6% interest rate, but it's based on the lender's discretion and what they offer you. So if you, for instance, if you're getting a $300,000 loan, all right, and they're offering you to buy down the points and say that you can pay 1%, which is $3,000, and that'll reduce your interest rate by 0.5%. Okay, so it'll go from a 7% down to a 6.5%, and that will cost you $3,000. Okay, that's something that they could offer. Or maybe it's 0.25% or 0.75%. That percentage that they offer you is going to be based on the actual lender and what kind of deals they have. Okay, so you want to shop that. But also, let's say you have $6,000 and you want to buy it down by a full point. You want to go from 7% to 6%, and they have this sort of program in place. That is a discount point. Okay, those are called discount points. Now, other mortgage points that you hear about is called loan origination fees, and this is where the lender charges you the money that they're going to make. All right, so they say something like we charge 1% of the loan, and that's our fee, or they have a flat fee. They might have a $1,000 flat fee to do the mortgage. Okay, so all that sounds good. Now, why do lenders offer these? Well, the loan origination fees, they're going to be set in stone. The lenders, that's how they get paid. That's their fee. If you don't do any discount points, then that's where they make their money. And that's typically going to be pretty standard across the board, no matter which lender you talk to. It's just a matter of what they charge and how they charge it. But what benefits does the lender get from offering you discount points? Let me explain this to you real quick. All right, if I'm a lender and I have, let's say I work with an investor or investment company or whatever the case is, and they tell me, Phil, you have $1 million to write loans on, okay? And I speak to you and I say, listen, I'm your lender, and and we're writing a loan together, and it's $300,000. All right. Now, the process for me to get paid the most money up front will be I'm going to get my loan origination fees, but if you will pay the discount points, then I also can collect that money. Okay, and then what they'll do is they'll sell that mortgage on the secondary market to free up the capital so they can go back in and do it again. All right, so if they charge on a $300,000 mortgage, if they can say, hey, do you want to buy down the points from 7% to 6%, this will cost you $6,000, and they have $1,000 loan origination fee, then technically they're getting $7,000. Okay, and then if they can sell that mortgage quickly on the secondary mortgage market because it's a lower interest rate mortgage, and you have a good file, good credit score, these sorts of things, and they can go in there and they can sell it, and they'll sell it quickly, and it'll free up capital for them to go in and write the loan on another borrower. And that is how lenders make money. Okay, so if you've ever had your house or you've ever had a mortgage and your mortgage has been sold to another lending institution, this is what happened. They just wrote the primary mortgage up front, and then they sold it to somebody on the secondary mortgage market. It's very standard. It's actually a good practice, and a lot of these bigger companies like Mr. Cooper and stuff, they hold mortgages, and they're good at managing it. It's much better experience for the consumer, and they offer all kinds of refinance options, and they offer home equity lines of credit, all kinds of stuff, and that's their business structure. Whereas a lender is really they're probably they don't want to hold a note for too long because they need to free up capital coming from the investors that they're partnered with, and that's the way it goes. Now, when it comes to discount points, okay, one thing you want to keep in mind is the break-even total. All right, so if you gotta really dive deep into this because it's typically 3 to 5 years, right, for a before you hit the break-even point, which is where you say, okay, I want to buy down $6,000 worth of interest on a $300,000 mortgage, at what point will I hit that break even point? At what point will I recoup that $6,000 because I'm saving money every single month on my mortgage payment because I bought down the interest rate? You have to know that, because typically it's somewhere between 3 to 5 years, usually closer to the 5 year mark, where you're going to hit that. Okay. So you got to also understand that most people on average buy and sell a home within 4 years. Okay, so you're pushing the average, and a lot of people move into a house, they stay there for a little while, then they sell it, and they don't realize that they paid all those points. They didn't save any money because they didn't hit their break even point. They actually end up losing money. So if you're going to save 50, 100, 150 bucks per month, you got to calculate that out and say, okay, I spent $6,000 times $100 a month, and this is how long I need to stay in this house before I break even here. And then you got to consider that how much longer you're going to stay in that house for it to actually benefit you and be profitable. Because remember, the 3 to 5 years is just break even on what you're spending for discount points. Okay. And that's how the game is played. And this whole real estate thing, it's a big game. You got to understand it. All right. So that pretty much covers the discount points. It's not something that I'd be too concerned with. For me, I don't care about discount points. If there's opportunity to refinance, that's something that I would probably do over trying to pay for discount points. I believe firmly in keeping as much money and as much capital with you in this, when you're doing a transaction like this, as possible. Because if you've never bought a home, then you're going to find out that if you spend all your money on discount points, all of your money on down payments, all your money on closing costs, and all your money on furniture and all these fun items that you need, then you're going to find out that houses need a lot of maintenance and you have no money to do that, and it's problematic. So when I advise buyers that are new to this, I always tell them you should keep as much money as humanly possible, because these things come up with houses. They're just a machine with a lot of turning parts at all times that need maintenance at all times. So it's something to think about. And yeah, for me, I always like to have capital, because there's a strategy to actually putting money towards a balance versus paying all this money up front to lower interest rates and do these sorts of things. I think you can save more money by actually paying down the balance, which actually reduces the interest that you pay over the longevity of the loan regardless. So those are some things to think about. And of course, if you need anything, we're here to help. We represent buyers and sellers, and just give us a call anytime, reach out anytime, send us a message, whatever the case is, and we're happy to help. All right, take care.